Some investors have been bullish on the U.S. while tempering their enthusiasm for China as they worry about a possible market bubble there. Our next guest is making a big bubble, or a big bet, the debt bubble might burst. Joining us first on CNBC from London, famed short seller Jim Chanos, president and founder of Kynikos Associates. What are you doing in London, Jim?
I'm trying to hold the fort down here, Joe, as you can see. Working hard for you guys.
Yeah. For a while, we thought we were going to, again, retake the mantle from London as the financial capital of the world until maybe last week when we saw that we're going to get serious here about some punitive measures against guys like you and actually legitimate guys as well. Just kidding. But it could be against hedge fund guys and bankers, Jim. What do you make of all the stuff you read in the last week?
Well, it's clearly aimed at the trading activities of the banks, not hedge funds per se, but hedge fund activities within banks. And I actually think it's a move in the right direction. A lot of commentary notwithstanding on the other side of the coin. I think that we should not have our deposit-taking institutions subsidized for taking trading risks. They can take trading risks, but not with the taxpayer money at risk.
Yeah. What about some of the other proposals about, I guess, you're not a bank either, so you probably don't care if we tax these guys to pay off GM's and AIG's problems?
Well, I think, I don't think anybody gets preference here, just as the union shouldn't have gotten preference in the healthcare situation. I don't think any of the TARP recipients should get preference. So that's bad policy, and that I don't agree with.
That you don't agree with. All right. Can you believe what's happened in China recently? And it was weird. I think you first told us a year ago about China. Would you give? Was that the New York Times or was it the Journal? Did you give?
He didn't even talk to them. He was making a speech somewhere else, weren't you, Jim?
It became like a stop the presses. Chanos thinks there might be a bubble in China, and it had been a year that we'd been talking to you about it.
Well, I think they didn't like me comparing it to Dubai times 100 or 1,000, which I did say on your program, somewhat tongue-in-cheek. But yeah, one of the papers of record picked it up a few weeks ago. But we've been sounding cautiously an alarm there for a while. It's a little bit more visible and voluble now. I'm giving a couple talks in London and in Oxford this week about it because our work has really come together on the real estate side of China. We're not calling for an impending crash of China or of the Shanghai stock market, but in particular, the bubble that's been blown up in real estate, both commercial and residential, as well as other forms of fixed asset investment in China. It's unprecedented and really staggering when you... One fun fact I mentioned was that right now, for commercial real estate, there's 30 billion square feet under construction. Now, not all that will probably get finished, the way the Chinese do these numbers, but to put 30 billion square feet under construction in context, that would be a 5-foot by 5-foot office cubicle for every man, woman, and child in China.
Wow.
And
yeah.
that's a lot of space.
Yeah, and you've said that, also tongue-in-cheek, that it's not quite, but there's almost a skyscraper for every peasant moving from the farm at this point.
I didn't say that, but I mean, you get the gist. I mean, the amount of fixed asset investment that's happening here to keep the GDP growth. And let me point out something that's very, very important to your viewers. That in the West, GDP growth is the residual of the free market. That is, everybody does their thing, the businessmen plan, consumers buy, save, invest, whatever, and GDP is the end result. In China, it's quite a bit of a different thing. Very similar to the good old Soviet Union, GDP is a planning tool. And GDP, we start with the GDP target and then figure out how it is we're going to get there. And that is a much, much different animal. And I find it interesting that Western investors that would eschew government involvement in things like healthcare or automobile, industrial policy, where generally governments don't do it that well, in China's case, are more than happy to have 5 to 9 guys in a room figure out a very complex economy and always seem to deliver a GDP number right on target, quarter in, quarter out.
Yeah, that
one strikes me as that is a little fishy.
Yeah, the central planning that we see. But I've wondered about that myself, Jim, that if you keep allocating capital as they can do whatever they want because it's centrally planned. If you keep allocating it where it really doesn't make economic sense, you figure they're very powerful over there. They can do it, they can hold their currency down. They can do all these things, but does sooner or later do market forces take over in a non-market economy?
Absolutely. Command economies can marshal resources very, very well. When Khrushchev banged his shoe proverbially or literally at the UN back in the early 60s, he said, "We will bury you." He was talking about economically, not militarily. And the Soviet Union grew very, very rapidly after the post-war period, as did both Germany and Japan. The Soviet Union marshaled resources, moved population from rural areas to urban areas, educated its workforce, and then finally threw lots of capital at it. Germany and Japan did the same thing, but where they differed was once that all happened, the German and Japanese economy began to use those inputs more and more efficiently. So the need for increased amounts of capital dropped off. In China, and to a lesser extent the Asian tigers in the 90s, what we've seen is more and more fixed asset investment is needed for a dollar GDP. So they're getting less efficient, not more efficient, and that's a troubling sign. And one other point on the political versus the economic there, it's an interesting aside, and others have made the point before me, but I find it intriguing as we've done our work that it's become very apparent that China has embraced capitalism to keep the socialist elites entrenched, while more lately in the West we've embraced socialism to keep the capitalist elites entrenched. So a little bit of opposite sides of the same coin.
Yeah. We also saw, Jim, that the people that aren't bearish on China, or aren't worried about a bubble, said, look, they got it under control. Look what they did last week. They obviously know they need to keep things from overheating, so they've got a firm grasp of the situation. Is that true? And number two, how bad would it hurt us if your worst case scenario, how much will that hurt the rest of the world if it comes true?
I mean, what would hurt, I think primarily one of our conclusions is that it would hurt the building materials sectors, the commodity plays in the West, the iron ore miners, the steel manufacturers, cement, all the kind of places, copper, all the kind of places where demand is because of the China bid. And I think that would be the place to, we're not making any macro call on exchange rates or current account flows. That's well beyond what we do. But in the world of what we do, looking at companies, I would be very leery